Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
This is the Diwali day, so I'm gathering the courage to talk about a financial issue, about money. In fact, in this case, the dollar or the dollar-rupee exchange rate. Now, this is an important issue, and before we go anywhere deeper into it, we have to understand a few things. First of all, we have to understand that the exchange rate, that is the number of rupees you have to spend to buy a dollar, or the number of rupees you get in exchange for a dollar, that keeps varying from time to time. As we have seen, it wasn't fluctuating that much in our past. But remember, in the past, when it wasn't fluctuating that much, there was a black market. You could go to the back lanes of Janpath in Delhi or the back lanes of Connaught Place and Paharganj or Kashmiri Gate or many of those areas where dealers would give people dollars or pounds or any foreign currency, convertible foreign currency, in exchange for rupees. There used to be a street premium. That is something we've talked about Pakistan in the past, also Sri Lanka. That is where the street premium on their currencies had really risen. That's when your currency is not finding its actual level in free markets and a premium in the market builds up. Now, some difference between your official bank rate and maybe what is called as real effective exchange rate, that difference may persist. Usually, it might be the difference between, say, the inflation rates between your country and the American inflation rate, because our currency is pegged to the dollar. Usually, American inflation rate has been much lower than India's, and that's why rupee keeps depreciating from year to year to year. That is in the normal times. However, a combination of other factors can also lead to appreciation of the rupee or depreciation of the rupee. Your economic growth, in times of growth, more money comes in from outside. Your exports are better, so there is more foreign exchange available, so your currency appreciates. In times of trouble, for example, lately FPI's foreign portfolio investors have been selling so much in India and pulling out a lot of money. Maybe they are going to China because Chinese markets have suddenly looked up, or elsewhere, or in the past when the Americans started upping their interest rates. A lot of people thought it's much safer to be in American bonds and earn higher interest rates than take the risk in Indian markets or any emerging markets. So the money went out. When that happens, a downward pressure builds on the rupee. So rupee starts to weaken. What does the RBI do in this case? RBI is the regulator. RBI traditionally since 1991, since India reformed its economy, has increasingly followed a liberal policy on this, a liberal policy of letting things be, except not intervening, except when there is a wild fluctuation or when they might see a run on the currency. I might like to remind you that 2008 global financial crisis, there was a fear and apprehension that George Soros and people like that were collecting money. They were collecting a war chest to raid the Indian market because they suspected the Indian government then may heavily intervene in the currency markets. The RBI may heavily intervene in the currency markets to shore up the rupee, to prevent the rupee from weakening too much. And when that happens, then people like that, currency fluctuators, they can speculate in that market. That's precisely what happened and what led to the Eastern financial crisis, Eastern Asian financial crisis in 1997, 1998. First of all, the Thai baht had a meltdown, and then the contagion spread, and several of the fairly successful East Asian economies until then went through this terrible financial meltdown, which it looked like at one point will take the global economy down. That was the biggest international financial crisis before the 2008 financial crisis triggered by the Lehman Brothers collapse. Now, the lesson of these crises has been that reformed economies let their currency float as freely as possible. So in India, between 1991 to 96, increasingly the currency was allowed to be relatively free. It was never allowed to float fully. The RBI would always intervene when there were fluctuations. From 2006 onwards, all the commentators who write about this tell us that this regime became even more liberal. So the RBI also acquired more confidence. However, it looks like over the past 5 years, that is 2019 onwards, this has changed. Now, to understand this, please look at these two graphics. So one is the graphic that tells you the movement in the rupee, say in the last 10 years. See, rupee as to dollar. See how rupee keeps on weakening. As the graph goes higher, it means you are spending more rupees to buy a dollar or getting more rupees for a dollar. So rupee is weakening. Then at some point from 2009, after that, it begins to flatten, and then over the last couple of years, that is say around December 2022 onwards, you found it flatter, quite flat. In fact, 2022 to now, this graph has been quite flat. How does that happen? So various experts are saying that's happened because the RBI has now decided or has been mandated, or maybe it's a political decision, not to let the rupee depreciate any further. So somehow, mentally or politically, a price has been determined which is 84 or thereabouts, that it doesn't look good, it looks a bit ugly if rupee becomes weaker than 84 to a dollar, so keep it there. Now, where are we drawing our wisdom from? Obviously, these are opinion writers, and there will be contrary opinions as well, and I'm sure on the government side, RBI governor, for example, in a recent public statement, had in fact taken great pride in the fact that exchange rate in India has been quite stable. What he didn't say was that it's because he was intervening a lot, and probably, maybe he's not intervening as much as these critics say. The critics, however, give us some data, and I will quote from these critics and their articles and explain things as we go along. Remember, this is not really my domain, and I am also taking the risk and gathering the courage of doing this while our editor for economy, TCA Sharad Raghavan, is on a short vacation. That said, so the first article that we should read is an article by Arvind Subramanian, our former chief economic advisor, and Josh Feldman, also a noted economist who used to be the IMF representative in India. This article is in Business Standard, as is the other one that I will mention, article by K.P. Krishnan, a former civil servant and now a scholar with ISAC Center, also from the same paper. By the way, that's also the paper in which my weekly column, National Interest, also appears simultaneously. Now, in this article, Arvind Subramanian and Josh Feldman, the headline of the article, this only came out 2 days back. Headline is, has India's exchange rate mechanism changed for the worse, right? So they actually make that statement, but there's a question mark there. What are the main points they are making? First of all, they say India has radically altered the exchange rate policy from flexible to inflexible, which means earlier, if there was depreciation, they'd let it happen, if slowly but naturally, or appreciation, they would let it happen and intervene only if there was a wild fluctuation or there was a sudden fluctuation, but otherwise they will let the market find its level. Number two, because of this, it might be affecting India's competitiveness, India's export performance, economic growth, and external resilience. What is external resilience? External resilience is the higher your foreign exchange reserves, the greater your external resilience. Now, you might say, what are you talking about? India's foreign exchange reserves are today $700 billion, right? It's a lot of reserves, particularly if you compare with our neighbors, but that really should not be our comparison. India is a continent-sized country with this continent-sized ambitions. So, more reserves India has, the better. These economists say that if India had followed a more flexible, continued on with the usual flexible foreign exchange policy, maybe the rupee would have looked weaker to the dollar, maybe 86, maybe 87, maybe 88, thereabouts. But at the same time, RBI would have had maybe $100 billion more of reserves, because they say that in a finite period of about less than 2 years, RBI has spent $130 billion to shore up the rupee, basically to ensure that rupee does not cross that barrier of 84 and goes beyond it. So you can see this graphic, rupee goes to 84, just over 84, it again comes back and finds the same level. These economists are suggesting that is happening because RBI is then selling the dollars, and if RBI was not selling these dollars, then that 130 billion that the RBI sent to shore up the rupee, most of it would have been still in India's reserves, and that would have given India more strength. And a weaker rupee or a stronger dollar and a weaker rupee would have strengthened India's export competitiveness. Now, I know there is a counter argument to that India is fundamentally an importing country. India has a large trade balance. So wouldn't it make imports also more expensive, particularly oil imports? There are arguments for and against that. I will go over them as we go along. These economists also say, Arvind Subramanian and Josh Feldman, that because of these interventions between February and October 2022, RBI lost $105 billion in reserves. They say in their article that a reserve devaluation of this magnitude had never occurred in Indian history. That's the reason they are suggesting that RBI has now decided to peg rupee dollar to a certain rate. And between July and October 2023, they've again sold $25 billion from India's reserves to keep this rate. That means if there is more demand for dollars, they just release those dollars instead of letting the rupee weaken. Now, how does it work? I get the explanation from K.P. Krishnan's article. K.P. Krishnan uses the example of pencils. He says if the price of pencils goes up, that means the demand for pencils is going up. When that happens, for some time the manufacturers benefit. Then taking the cue, because there is a nudge, there is a signal from the market that there is demand for this, production of pencils increases and price starts coming down, and maybe at some point a balance is achieved. So the price goes up a little, but it comes down from its peak, but the supply increases. However, government may decide at any point of time that and that is what used to happen in license quota Raj in the era of the Mai-Baap Sarkar, that this is too expensive of pencils. So they can declare pencils an essential commodity and say this will be the price, can't go higher than this. That's when all kinds of negative consequences visit us, because that's when the Mai-Baap Sarkar gets in the way of the markets, and that's where shortages develop, and that's where the industry loses its competitiveness. If you find the example of the pencils too far out, or maybe you don't like the fact that I've just lifted the idea from K.P. Krishnan or anybody, you can use the game that's played out every year, the tragic game over onions, right? Anytime onion prices goes up, this is the period when onion prices will go up, because now we are at the end of the new sowing cycle has just started. So the earlier harvest is now more or less finished. But this is the time that farmers or traders who have some onions can get a higher price. So the nudge in the market is that the prices are higher, so those who produced can make more profits. But the government decides always that this is an essential commodity, you can't store too much of it. I'm banning imports, no more can come in, and if anything, I will buy up this stuff in bulk. So I will run my Kandha expresses, my onion express trains, and I'll bring these at a particular price, right? That is acting against the markets and against the farmer's interest. However, if the government had allowed the onion price to float freely, maybe the farmer would have said, it's a good idea, right? I can maybe create storage capacity. Other people can build storage capacity. Onion prices go up at a certain time. So I should plant more onion. And if I have the wherewithal and storage capacity, or if there is cold storage, I will keep it there. So the farmer, whoever runs the cold storage, the retailer, will benefit from higher prices in the off-season months. At the same time, price will not be as high as would have been if this extra production, which was because of a nudge from the market, price signals from the market, had not come up. That's how efficient and good markets work. And that's how they'd been working with currency as well till 2019, when it looks like this regime changed. And that could come from what I might call as currency nationalism. That is, stronger currency means a stronger nation. In real life, that is not quite true. Unless your currency is really so weak that it becomes confetti, right, or toilet paper. That happens in some countries, right? There were times in Afghanistan, say Zimbabwe was notorious, Venezuela. Those are completely broken economies. There, those things happen. Otherwise, for strong economies, a weaker currency is not always a curse. In fact, the entire argument that the Americans have with China, or that the developed world has with China, is that the Chinese artificially keep their currency a little bit weaker. And because they keep it a little bit weaker, it makes their exports more competitive. And that's why manufacturers in America, Germany, etc., can't compete. And that forces many of them to shift their production also to China, because China manipulates it. The charge is, and you will find, if Trump comes to power, you will find this charge repeated again and again, that China manipulates its currency price. So what do Subramanian and Feldman suggest? They say, first of all, there should be a three-pronged approach. That is, allowing depreciation in the currency when capital outflows put downward pressure. Number two, allowing appreciation when there are rapid inflows and exports grow and productivity grows, which puts upward pressure on the value of your currency. But third, build reserves when there are strong inflows. Build reserves when there are strong inflows, so your currency doesn't appreciate overly so as to disadvantage your exports. At the same time, when it seems to depreciate too strongly, then intervene to just make sure that the market does not get any jerks. However, a manipulation of your currency value, whether to make it weaker as the Chinese do, or to make it stronger as it looks like India might be doing now, that hits you, and I quote from the article, that hits you with a double whammy of reduced growth and also reduction in macroeconomic resilience, which comes from foreign exchange reserves. Once again, 700 billion looks like a lot, but see also how India's foreign exchange reserves have moved over time. India's foreign exchange reserves have not started growing lately, not over the past 3, 4, 5, 7, 10 years. They've been growing, but it's not as if they boomed all of a sudden out of the blue. They've been growing since 2002. In 2002, the Vajpayee government started carrying out fairly major reform, following up on the first burst of reform by Narasimha Rao, Dr. Manmohan Singh. A big reform took place in 2002-03 by the Vajpayee government. That gave them the idea of India shining, because suddenly it fired up growth. In 2002, however, India's foreign exchange reserves were $59 billion. It was still seen as healthy by Indian standards, but $59 billion. By 2018, that's fourth year of Modi government, these had already come to 400 billion. Right now, it is 700 billion. So all these large inflows, RBI is absorbed, and because of that, there was a high growth in the economy. At the same time, there was high export growth as well, because even while these inflows were coming in, RBI kept on stocking them up in reserves and did not let the rupee appreciate too much. So rupee remained competitive, and that contributed to India's export. India's export growth annually between 1994 and 2018. That includes 4 years of Modi government. 1994 to 2018, India's export growth was 10.5%. From 2018-19 to now, it has come down to 4.5%. So India's export growth has more than halved. Now, has it all happened because you've kept the rupee stable? You've not let the rupee weaken or find its level? These economists tell us that, look, we can't be sure that all of it is because of that, but generally you would say that a 10% gap in real effective exchange rate, or a 10% appreciation, which is not justified by the market forces, will lead to a 5 percentage point fall in exports, because that's how your competitiveness goes down. And that's happened in 2 years. And if competitiveness is maintained, exports will go up, your GDP will be stronger, reserves, they calculate, would have been higher by $130 billion. Now, the counter argument to that is that, look, if the rupee weakens, it may be good for exporters, but India is a country that imports more than it exports. So, won't the imports become expensive? Now, there is an answer to that. One, we mostly import oil. So, one answer could be to cut or reduce import duty on crude oil. Why are we putting import duty on crude oil? Government will lose some tax. But on the other hand, by keeping the rupee artificially at this price, artificially at a more moderate price, which means 84 instead of say 85, 6, 7, 8, 9, whatever it might have been, it's making imports cheaper. So to that extent, this becomes an import subsidy given by Government of India, Reserve Bank of India, by the State of India. So should a country be subsidizing imports, or it should be supporting, if not subsidizing, it should be incentivizing exports? So we are now caught in a completely distorted economy, where by keeping the rupee artificially high, we are subsidizing our imports. We are making our imports cheaper while making our exports more expensive. So our export growth has more than halved from 10.5% to 4.5%. That's the logic. Once again, what else do we import in large quantities? We import gold. So do we really want to keep the rupee at a strong level to make gold imports cheaper, or won't it be better if gold imports become more expensive? So maybe people will be importing less of a precious metal which is not of much use to the economy once it comes into the families, etc., etc. So all of those are arguments in economics. All economics at the end of the day is politics, but the fact is that a freer approach, a more relaxed approach towards currency markets has actually benefited India a great deal. India's economy has grown faster, India's exports have grown faster, India's inflation, barring some periods, has not gone out of control, and there does not seem to be, according to these arguments, there does not seem to be a particular logic in taking pride in such stable exchange rates, because the history of humankind tells us, particularly of 20th century and after that any country which indulges in currency nationalism by way of keeping its currency artificially strong ultimately comes to grief, because the street value of the currency builds up. Right now, it hasn't built up, particularly in India. Maybe the premium on the street is 2 rupees, 2.5 rupees. It isn't alarming at all. But in the long run, those are the consequences that visit these countries. I have personally seen this in the Soviet Union, because the ruble exchange price in the bank was something else. On the street, in real life, it was about 30 times higher. So you could buy nothing with the ruble. In fact, so much so that if you travel to the Soviet Union as an Indian citizen, which I did as an Indian journalist, I was allowed a certain allowance in foreign exchange. It wasn't given to me in dollar. It was given to me in what was called as convertible rupees. So I could go to my hotel and use these traveler's checks in convertible rupees as if they were convertible at a kind of dollar rate into a ruble, at a market denominated rate, not at the street rate. It was very, very, very complicated, and for the country which had these currencies, also quite disgraceful and quite embarrassing. Iran has had this problem, street value and bank value. Venezuela, so many of these countries have had this problem, and currency nationalism has never worked anywhere. However, in the run-up to 2014, currency value had become a big issue, because that is when the rupee had seen rapid depreciation in Manmohan Singh's last 3 or 4 years, and the opposition made a big issue of that. Said rupee is in free fall. When we come to power, see what happens. That's when many people said that when Narendra Modi comes to power, rupee will then be 45 to $1 or 40 to $1. Also, another very wise person, a holy person, even said that when Modi comes to power, it will be 1 rupee to $1. Now, those things we can talk about. those may look good, but if they look good to you, you are very old-fashioned in terms of modern economics, and you are living in a very different era that doesn't exist today and that doesn't work today. So once again, the debating point, should you then keep on spending from your reserves to keep the rupee value at this level, which you seem to have determined politically, or should you relax things a little bit? So again, the question in conclusion, and that's a debate, should you peg the rupee value to where it is now, even if it costs a little bit more foreign exchange from your reserves, because you have enough reserves, you can play with them, there is no danger of running out of reserves, or because this is damaging your export competitiveness, and it's also creating a moral hazard by subsidizing your imports. You are subsidizing your imports by giving your importers a cheaper dollar. Is that a good idea, or should you subsidize, or should you support, or at least not impede your exporters by giving them, I'm not saying a cheaper rupee, but a reasonably market denominated price for the rupee? That is the debate that these arguments have raised.